Your salary hasn't changed, but somehow food now costs double. You're spending more on fuel, more on school fees, and even the price of bread seems to rise every week. Your savings can no longer stretch the way they used to. The truth is, your money is losing power, and the question many Africans are quietly asking is, why? Welcome to Africa Finance Watch, the channel where we break down the complex world of African economics into real, simple, relatable conversations. Today's video tackles one of the most pressing issues affecting nearly every African country: the dramatic fall of local currencies. From the Nigerian Naira to the Ghanaian Cedi, the Zambian Kwacha to the CFA franc, local currencies are weakening at alarming rates, and we're here to explain why this is happening, how it affects your daily life, and what you can realistically do about it. Let's begin with the basics. Currency depreciation refers to a situation where your local currency loses value when compared to stronger foreign currencies, particularly the United States dollar or the euro. When this happens, it takes more of your currency to buy the same amount of goods or services, especially those that are imported. That's why you might be earning the same salary, but suddenly you're able to buy far less than you could a year ago. Let's make this more real. In 2018, one United States dollar was equal to about 360 Nigerian Naira. Fast forward to 2024, and the same dollar now exchanges for over 1,400 Naira. That's a more than 300% drop in value. So, if you were earning 100,000 Naira monthly in 2018, it had the purchasing power of around $278. Today, that same salary is worth less than $70. The same story is playing out across many African nations. In Ghana, the Cedi has lost significant value in just a few years. The Zambian Kwacha, Kenyan shilling, and Sierra Leonean leone have all seen steep declines in recent times. This currency decline is not just an economic concept, it's a daily struggle. Take the example of food. In Ghana, a loaf of bread that used to cost 5 cedis a few years ago now sells for 15 to 20 cedis. In Nigeria, a basket of tomatoes that cost 200 Naira just 2 years ago now goes for 700 or more. What's causing these price hikes? Part of it is inflation, but much of it has to do with the fact that these goods, or the ingredients and fuel needed to produce and transport them, are affected by the rising cost of foreign currency. Fuel is another good example. In most African countries, fuel is imported and purchased in dollars. So, when local currencies fall, fuel becomes more expensive. This leads to a chain reaction. Transport becomes more costly, and so does everything that depends on transportation: food, building materials, medicine, school supplies. It becomes a vicious cycle of price increases that affect everyone, especially those with fixed or low incomes. Now that we've established what's happening and how it affects you, the next question is, why are these currencies falling in the first place? One of the biggest reasons is Africa's heavy dependence on imports. Many African countries import the bulk of their food, fuel, machinery, medicine, and even basic consumer goods. Every time a government, company, or individual wants to buy something from abroad, they need to convert local currency into foreign currency, usually dollars. When too many people are demanding dollars and there's not enough supply, the value of the local currency drops. It's basic supply and demand. The more we depend on foreign goods, the more pressure we place on our currencies. Another major factor is debt. African countries owe billions of dollars in external loans, most of which are denominated in dollars or euros. As local currencies depreciate, the cost of repaying these loans skyrockets. Ghana, for example, defaulted on parts of its debt in 2023 and had to seek an emergency bailout from the International Monetary Fund. Zambia has also faced significant challenges restructuring its external debt, and Ethiopia missed key payments as well. These financial troubles shake investor confidence and further weaken local currencies. Interest rates also play a role. Central banks in African countries often raise interest rates in an effort to fight inflation. While this move is supposed to attract foreign investment, it doesn't always work in Africa's favor. especially if the economy is unstable or foreign reserves are low. Furthermore, in some countries, governments resort to printing more money to fund their budgets. But printing more currency without a matching increase in goods and services leads to inflation. More money chasing the same amount of goods drives up prices, and the value of the currency falls even more. Another global factor at play is the strength of the United States dollar. When the U.S. Federal Reserve increases interest rates, investors around the world tend to pull their money out of emerging markets and place it back into U.S. assets, which are now offering better returns. This capital flight leads to a stronger dollar and a weaker African currency. It's a trend that has been consistent over the past few years and has hit developing economies the hardest. Let's now take a closer look at specific countries to better understand how these issues play out on the ground. In Nigeria, the Naira has lost over 70% of its value in just the past 2 years. After the government floated the currency in 2023 and removed long-standing fuel subsidies, the exchange rate unified, but inflation remained sky-high. Businesses struggle to get dollars for imports, and ordinary Nigerians are facing the worst cost-of-living crisis in decades. In Ghana, the Cedi has also suffered major losses, especially in 2022 when it was labeled Africa's worst-performing currency. The government's decision to seek an IMF bailout and restructure its debt signaled how serious the situation had become. Inflation soared, and basic food items became unaffordable for many. In Zambia, the Kwacha declined sharply due to delays in debt restructuring and low global copper prices, which is the country's main export. Even though the government has secured a deal with the IMF, investor confidence remains low, and the economy is still under pressure. In Zimbabwe, the government introduced a new currency in 2024 called the ZiG, short for Zimbabwe Gold, backed partly by gold reserves. This was an attempt to stabilize the currency after years of hyperinflation. Whether it will succeed remains to be seen. Then there's the CFA franc, used by 14 countries in West and Central Africa. Pegged to the euro, the CFA franc is seen as more stable than many floating African currencies. However, critics argue that it limits economic independence and keeps these countries tied to European financial systems. There have been increasing calls for West African countries to establish their own regional currency to gain more monetary autonomy. The good news is, there are ways to fight back against currency decline, both on a national and personal level. One of the most important long-term strategies is to boost local production. The more we produce locally, especially food and essential goods, the less dependent we become on imports, and the more we can protect our currency. Ethiopia, for instance, has invested heavily in its textile and leather industries. Egypt is building local car assembly plants to reduce vehicle imports. Nigeria is working to expand its rice farming sector to achieve food self-sufficiency. Another key strategy is to add value to exports before selling them abroad. Right now, most African countries export raw materials and then import finished products. Ghana, for example, is one of the world's top cocoa producers, yet it imports chocolate. Nigeria exports crude oil, but still imports refined petrol. If African countries can build industries that process raw materials into finished goods, they can create jobs, generate more foreign exchange, and strengthen their currencies. Pan-African trade is another major solution. The African Continental Free Trade Area, or AfCFTA, aims to boost trade between African nations, reduce dependence on foreign currencies, and promote the use of local currencies in cross-border transactions. If implemented effectively, AfCFTA could reshape the African economic landscape. Imagine buying Ethiopian coffee with Kenyan tea, or paying for Ghanaian cocoa with South African wine, all without needing dollars. That vision is not only possible, it is necessary. Finally, on a personal level, there are steps you can take to protect your finances. One of the most effective is to save in more stable currencies or assets. If you have access, consider diversifying your savings into dollars, euros, gold, or even real estate. Many fintech apps now offer access to dollar-based savings or investment platforms, even with small amounts. You can also start a side hustle. In today's volatile economy, relying on one source of income is risky. Whether it's online freelancing, local trading, or digital services, extra income can help you stay ahead of inflation. Budgeting wisely is another powerful tool. Track your spending, prioritize essential expenses, and reduce unnecessary costs. Financial literacy is more important than ever. The more you understand how money works, the better your decisions will be. So, to wrap up, African currencies are falling due to a combination of local and global factors. These include overdependence on imports, high levels of foreign debt, inflation, weak production capacity, and a strong US dollar. You feel the impact in your daily expenses, shrinking salaries, and a rising cost of living. But there are solutions, both at the national level through smarter policies and at the personal level through financial discipline and informed choices. What about you? How are you coping with rising prices in your country? Have you tried any of the tips we mentioned today, like saving in dollars or starting a side business? Do you believe your government is doing enough to stabilize the economy? Let us know your thoughts in the comments. Your experience could help someone else navigating the same challenges. If this video helped you understand what's happening with your money and what you can do to adapt, be sure to like this video and share it with someone who needs to hear this today. And don't forget to subscribe to Africa Finance Watch for more insights on how Africa's economy is changing and how you can stay ahead of the curve. Thanks for watching and see you in the next one.